Hello and welcome. Thank you for joining us today. I'm Stuart Arnold. I'm Director of Financial Planning here at Cullen Wealth, and I'm delighted to have with us today John Roe at Legal and General Investment Management. John, I'll hand over to you to introduce yourself.
Thank you very much, Stuart. So, hello, I'm John Roe. I'm Head of Multi-Asset Funds at Legal and General Investment Management. I've been with the firm for about 15 years. I've been in my current role for about 11. So I was instrumental in the setting up, for example, our very popular multi-index funds, where we've been working with Cullen Wealth for about 11 years. So I head up that team, work with all the fund managers, the strategists, the economists on the overall investment strategy and the fund allocations themselves.
Thank you very much, John. We're just going to spend 20 minutes or so, not sure of the length of time, just talking about some topical issues today to help you, our clients, understand what's impacting your investments and financial planning. So, John's going to help us with some of the key points of today's scenario. So, without further ado, John, let's talk about our new government. How do you see that impacting UK investors generally over the next 12 to 24 months?
Yeah, so I expect the first 12 to 24 months to be relatively smooth. So the first big important date is probably October, which will be the first budget from the new government and from Rachel Reeves post the party conference season. Now, they're already starting to make the odd talk of things are worse than expected. That was all pretty much what was probably our expectation. And the reason for that is that even though really, as the Conservatives have said, all their numbers were in the public domain, Labour are quite understandably trying to buy themselves a little bit of space to make some changes around the edges while sticking broadly to the Conservative spending plans. So if you go back to 1997, which clearly worked very well for Labour, a key part of their strategy was to stick to the Conservative spending plans for the first few years. So actually, even though they've amended the fiscal rule slightly, there's a fiscal rule that the government say they'll stick to, they've only changed it very slightly, and they've actually made it slightly tougher on themselves than the Conservatives previously. Now, in reality, post the Truss 2022 event, the market is really policing the UK very heavily. So Labour don't really have that much choice but to stick to the kind of starting plans. Now, what they probably will do is look to do a bit more taxation for a bit more spending. And they did this in 97. In 97, if your clients remember, there was the pensions windfall tax on pension contributions. Now, this time around, if we think about one area that might be targeted, could be pensions tax relief on contributions. So around 50% of the benefit of that accrues to about the 10% highest earners. So actually, it's quite targeted towards the top end, the benefits. And Rachel Reeves has previously, back in 2016 and 2018, highlighted that this is a kind of weird form of taxation where the highest earners get the greatest benefit from this tax relief. And she's previously talked about a flat 33% rate. So that might be one area that they look at. Now, importantly, if we think about where the marginal changes might be, well, we've got more political stability than we've had for the UK in a while. We've got a large majority and what appears to be a stable leadership of the Labour Party, which is clearly not something we've had under the Conservatives. And maybe that will encourage investment. And we saw ahead of the election that they did try to link in with figures from the city. So there was this panel of 10 advisors that Labour talked about to try and make sure they come across as business friendly. And they clearly have a somewhat more pro-European tilt. And I think probably on balance, the UK is more sceptical about Brexit than it was at the time that we undertook that. So probably that's seen as a positive by people in the country and potentially also for investment. Now, if we look at the Bank of England side of things, back in 1997, one of the shock announcements was the independence of the Bank of England, but we don't think that Labour have a similar rabbit in the hat this time. Last time around, it brought down the cost of borrowing because it brought down gilt yields in the UK when they announced that. But this time around, we think it'll be more steady as you go. The Bank of England's looking to cut rates if they can. They've been quite explicit about that. And we're probably expecting 1 to 2 interest rate cuts this year, which should start to help end consumers. Now, as we go forward a couple of years, clearly planning is an area they really focused on trying to give more people a chance on the housing ladder, if you like. In reality, achieving that's quite difficult. Planning is a particularly complex area in the UK. It's a lot more difficult than Labour have made it sound so far. But I still believe that given they've made it so central to what they intend to achieve, then that would be an area we can hope to see some movement over the next 1 to 2 years, that period that you've outlined.
Thank you, John. Inflation seems to have normalised. Interest rates are predicted to fall, you've suggested there. The cost of living crisis has caused some considerable adverse portfolio behaviour, particularly impacting the low medium risk investors. What are your views of the likely trends with inflation and interest rates for the next 12 to 24 months? And their impact on specifically, but kind of more generally, portfolios. I'd be interested to get your views on those.
Well, let's start with inflation because it's really the inflation that will drive what the Bank of England can do and what other central banks can do. So if we start with inflation, it's worth saying that investors and economists have been notoriously bad at forecasting inflation. So the biggest trap we shouldn't fall into is to say, oh, inflation's going to do X, because in reality it won't. And if we look at the Bank of England, since 2004, they've spent a lot of money trying to forecast inflation. But if you actually look at their 2-year forward expectations, so the kind of period you're talking about, there is no relationship between their forecasts and realized inflation over that period. It's a complete mishmash, no added value evident in their forecasts at all. It's quite shocking when you think of the amount of really clever people that really try hard at this challenge. So I think you almost have to embrace that uncertainty, and we can talk a little bit more about what that means for portfolios. So as you say, we have inflation coming down. We have UK consumer price inflation at around 3% from a much higher peak. And we have core inflation, which is a measure of the elements that are kind of more structural in nature, also coming down and been on a downward trend for around a year. And we would expect that to continue. We see no reason that we shouldn't see gradual normalization for inflation. Now, there's still those risks, though. So if you think about what is most important for anchoring inflation, well, it's really inflation expectations. And the good news is there that various measures of future inflation expectations by consumers or in markets are all quite benign. They're quite close to central banks' targets, which is really good news because that's suggesting that this period, this cost of living crisis and the terrible impacts it's had for some people have not caused a structural break in people's future expectations of inflation. And that's clearly where it becomes a lot more problematic. Now, I've talked a bit about the UK there, but we kind of have to talk about US inflation as well, because that's the biggest market globally and it's so crucially important for monetary kind of policy conditions. And there too, we've seen inflation coming down. The spike was never as high. So there was never as big a cost of living crisis in the US, which is actually good news globally because it means the US is a bit ahead of Europe and the UK in terms of its normalization of inflation. And again, we're probably looking at 1 to 2 rate cuts this year as that continues to improve. Now, where are the upside risks? Well, outside of commodities, and we could get an oil price spike at any time, of course. That can always happen. You can get some unexpected outage in supply. But outside of that, really the inflation pressure is in services and in wages. So we still have services inflation up at 4 or 5%, well above central bank's targets. And we also have wage inflation still up at that elevated level. And really, that's probably the thing that's most holding back central banks. But the risks to inflation are two-way. So what are the downside risks for inflation? Well, first of all, from about 2011 to 2020, inflation was consistently lower than forecast, and nobody really understands why. And if you don't understand something, it could happen again. So whatever was causing that lower than expected inflation could repeat itself. And then if we think about more specific causes, there are strong arguments for why artificial intelligence could be quite a deflationary force in economies, because it can bring down the cost of doing all kinds of tasks and in turn bring down prices. And alongside that, China's going through quite a difficult time, quite a deflationary period. And again, there's a risk they export that globally, that kind of deflationary power. So a point on inflation would be don't try to predict it. It's amazing how often I talk to people, not advisors like yourself, but say my dad. And my dad will go, oh, well, inflation's going to come down or it's going to go up. And I'm like, well, I can't forecast that. And therefore, I don't think you really should be doing either. Now, if we come on to bonds, the role of bonds in portfolio, they clearly had a very difficult time, particularly in 2022. And this year hasn't been a positive year yet for government bonds, but it's broadly getting closer to zero. Now, really the role for me of government bonds is twofold. First of all, we're at quite attractive yields now. So the yield and therefore the return, if people hold these bonds to maturity, is well above inflation now. So that's a really positive thing. If you said to a lot of investors 4 years ago, what if you could get a risk-free investment for 10 years that gave you a return that was considerably above where inflation was expected to be? You know, a lot of them would have bitten arms off for that. So to be consistent, it's quite valuable to have them in portfolios. Now, the second reason is, even though at the moment bonds continue to be quite volatile, they've performed well in 17 of the last 18 recessions in the US. So in the UK, we often think back to the period of the 1970s as an inflationary period, but even in the 70s, during an actual economic recession, bonds perform well. So actually, an important role for them is to help, particularly those lower risk investors, but investors more broadly, cushion the returns in those worst economic outcomes, those recessionary environments, which is clearly an environment where people feel the pinch more broadly in their kind of holistic well-being. So those would be the role we think they play. Now, we do own more bonds now than we did, say, 3 years ago. Our modus operandi, like all else equal, would be as bond yields get more attractive, we would look to own more. And we focus that primarily on the US, and we focus that primarily in inflation-linked government bonds. And the reason for doing that being I'm less caught out if we get a surprise in inflation. So that allows me to own more bonds, but in a way that's a bit more risk controlled for those end investors. Now, the one area of bonds we own less of at the moment, kind of end this question, is around corporate bonds. And corporate bonds aren't actually offering that much of a pickup above government bonds. So you're taking that risk, but actually the yield you're getting on those bonds is no longer that much higher. It's not as attractive as it was 1, 2, 3 years ago. And so we've been taking some of those corporate bonds and moving them into government bonds so that we're a bit more defensive for investors than we were previously.
A big advantage of taking a kind of a tactical view, which Legal and General does with its multi-asset funds, John, isn't it? Where you're moving a client's assets around, which is slightly different to one or two of the other funds we have in our centralised investment proposition.
Yes. So I think it was John Maynard Keynes said he changed his mind on something, and someone kind of pointed at him and, oh, you changed your mind. He goes, when the facts change, so do I, to paraphrase. I mean, that's the real joy of being dynamic, is that your circumstances do change. Today looks very, very different from 4 years ago. So our position would be, why would my starting point be that my investment portfolio looks exactly the same?
Yeah.
I want to be able to move it around exactly as you say as conditions change. And I absolutely understand why then that works well, potentially alongside others that are doing it differently.
Thank you, John. Thank you. Very, very helpful. You've referenced a fair bit of the US in the previous answer there. Obviously, the election over there is just under 4 months away. Keen to understand your views of this. Again, how it may impact investors over in the UK. What are you doing tactically with the portfolios to prepare and navigate through that?
Yeah, so I think the first thing I would say is that there's actually quite a lot of commonality between the two candidates, and not just their age. There is actually a surprising amount, if you like, the US political system was broken down, and the traditional divide between Democrat voters and Republican voters no longer exists. And as a result, their policies look quite a lot more similar. For example, both sides love spending money, absolutely love a fiscal stimulus. And so we can kind of expect continued positive fiscal spending regardless of who wins. So if we focus in on the bit that's most different between the two of them, that's really in three areas in our perception. The first of those is around immigration, and the Republicans would be expected to be quite a lot tougher there. And there's been talk of actually removing people from the United States who previously entered. And actually, immigration into the US has been particularly high over the last couple of years post the COVID lockdown. But that's actually supported the US economy, supported the growth, and actually helped bring down inflation. So, from an economics perspective, I'd actually say it's been quite a useful force at a time when otherwise the US was overheating. But that isn't how the Republicans see it, and that isn't how a large part of the electorate see it. And so, yeah, that would be the first difference. Now, that would be an inflationary move because you're taking away workers from the economy, and if you do that, you drive up inflationary pressures because you're tightening the labour market by removing those workers. The second area that they're different is around Donald Trump has highlighted a certain level of disdain for established institutions. So clearly he's had a few run-ins with the judiciary in recent times, and he's highlighted he doesn't feel that's as independent or as pro-Trump as he might like. And then also even there's been talk about maybe a bit of an interference with the Federal Reserve. Maybe the president should get a role in the setting of interest rates, which is quite a frightening concept. So that would be the second areas, would be the undermining of existing institutions, which is, or the changing. Let's not make it politically motivated. The changing of existing setups. And then thirdly, tariffs. And he's talked about global tariffs. And that's really the one that could be most impactful, because what happens when he tariffs one country is people reroute the goods to other countries. So your exports from China go down and your imports from Vietnam go up, right? And it broadly the same goods. Now, by targeting everyone, that would again probably be an inflationary pressure, because you're making everything consumers buy from abroad more expensive for US consumers. So I guess that the key areas we'd see is maybe a bit more of a risk premium around the independence of key institutions like parts of government or parts of the Federal Reserve, a potentially tighter jobs market, and then potentially some more inflationary pressure. How we think about that in portfolios? Well, first of all, we don't think this is the biggest driver in markets at the moment. So there's clearly been recently, for anyone who's not looked at the news, there's been a difficult time for Joe Biden and a significant increase in the odds of Donald Trump becoming president again. But actually, markets haven't reacted that much, which is a good signal that there are other bigger forces going on at the moment, such as inflation that we've talked about, and a bit of a slowdown in economic growth in the US. So I would say it's a factor, but it shouldn't be our primary driver of risk. How are we factoring it in? Well, actually, again, when we own those inflation-linked government bonds in the US rather than kind of nominal bonds without that inflation linkage, that gives us a little bit less exposure to the uncertainty that comes from the inflationary impact of either candidate winning. So that would be one good example. A second good example would be on the credit side. So I talked about owning less corporate bonds. That's focused particularly on the US. And that's because actually the US offers the least attractive credit spreads, in our opinion, at the moment. So the least attractive pickup to government bonds, but actually the greatest uncertainty. So that combination means that we target our lower corporate holding, particularly in the US.
Thank you very much, John. Moving on to more a global question now. Obviously, the world seems to remain and continue with its pretty precarious geopolitical situation. So, could you just run us through how Legal & General's viewing that, and what you're doing with the portfolios to do your best to help safeguard investors?
Yeah, this is always such a difficult area, and it's a particularly difficult area because there can be a very large disconnect between the humanitarian impact and the impact on deaths and on whole ways of living. And then the impact that has in markets can at times be quite disconnected, and that can almost very uncomfortable actually for investors too, because you see this big thing happening, but actually from an investment perspective, you're left trying to struggle with what is the so what for my end investor rather than the so what for good things and bad things that are happening in the world, for example. So that's the first disconnect. You've got to think, where is this having a macro impact on markets? So I think you have to particularly bear in mind the US and its relationship with the rest of the world. And we've talked a bit about how foreign policy might change depending on presidents. And clearly that could be a key driver of risk. A lot of actions have been taken, particularly against China in the last couple of years. So restricting the availability of high quality chips, for example, that actually they increase geopolitical tensions because you're creating a degree of conflict by limiting the growth of another country. And that can have unexpected knock-on effects. It can cause new partnerships between countries. It can cause a more adversarial approach from counterparties in non-economic areas. So I think probably the most important starting point, I'd say, is if you look at a global market portfolio, say global market cap equities, for example, which we don't tend to own, we tend to diversify a lot more than that. That can have very large concentrations of risk in particular regions or particular countries. And I think my starting point would be, when faced with uncertainty, don't try to guess which uncertain thing will go wrong. Try to limit your exposure to any single uncertain thing. Because that way round, you're not trying to be a soothsayer who's kind of pretending you're in the head of some leader of a country, particularly, if we take the Russian case, that it's a very small group of people making decisions there, and it's very hard to guess what that group's going to do. But what you can do is diversify by country, by asset class, by driver of return so that you're not too exposed. And then on top of that, try and stay alert to these changing dynamics. So clearly China and the US is a kind of change. Let me give you a live example of that. That has increased the threshold that we need to meet to go positive on Chinese assets. Why? Because the US has demonstrated that it wants to slow China down to a degree. And if it doesn't have the impact it wants to have, they'll tighten restrictions, which they've talked about doing on chips. So it's sort of a reminder that it's a headwind for that region, and that somewhat increases the barrier at which point you become positive on the asset class, for example.
Thank you. Final question, and then we'll let you get back to your normal day job, John. Many investors recently have benefited from the growth of what we describe as the Magnificent Seven, the seven biggest companies, I believe, that one can invest into today. And in some cases, the combined value of those companies is now bigger than entire countries, and in some cases, continents. They are huge in size, and they've been a huge influence over people's portfolios of late in particular. Could you just run us through your views of the sustainability of those, what you're doing in your portfolios to help clients to get the best of that, but also protect them against a situation where those stocks have a difficult time?
Yeah, so as you say, it is an unusual level of concentration at a global market level. So if you take market cap equities, for example, which again, as I said, we don't really invest in, we diversify more than that, you'd be up at around 20% of the index is the top 10 names, for example. And within that, you've got single names that are around the same size as, say, the entire FTSE 100. So you're kind of moving from things that are pretty diversified into things that might be a single company with a small number of return drivers and a much higher level of volatility. So clearly a single stock has a much higher level of price change movements than an entire diversified index does, because then all the companies are moving at different times and you benefit from that diversification. So it is an unusual level of concentration, and the Magnificent Seven is a bit of a false construct, because what people have kind of done is waited till seven things have done well and then group them together. So you need to be a little bit careful. And for me, a bit like for you, the focus is less on why they are a homogenous group, because they're not. It's on what are the impacts of having a small number of stocks that are such a concentrated element. I'm not a believer in the idea that because they're big, they must fail, nor am I a believer in the idea that they're too big to fail. Where we focus more is purely on the risk management. If I've got a small number of companies that are individually a large proportion of the universe that I'm invested in, that is kind of a new type of risk that's being added to my portfolio. That risk might be a good thing because they continue to do really well, or it could be a bad thing because they do really badly. So for us, the way we think about it is the importance of managing that risk is going up for a given risk appetite. Because clearly with your end clients, and we work with you very closely, they have an attitude to risk. And if the risk kind of starts to get bigger in some way, you've got to be more cognizant of that risk as it grows. So just because the US has done really well, and I think it's been the best performing equity region for something like 10 of the last 13 years, that doesn't mean it's going to do well for 10 of the next 13 years, because expectations are already very high. And if you look back before that period, the US was only the best performing region 2 out of the previous 20 years. So this isn't a given that it's the best performer, but it is a given that it's now 2/3 of global equity markets. So the way we work around that primarily is by being more diversified. But we do still challenge ourselves on, there is a value to owning these companies. So rather than removing them, it's about managing the amount we own by diversifying more and maybe finding other companies that have similar types of risk exposure. So maybe exposure to artificial intelligence, for example, rather than purely relying on, say, one or two companies that are particularly large and have that exposure, just to try and spread the risk around more names. So those would be the main ways that we try to think about it.
Thank you very much indeed. You'll be pleased to know that's the end of today's interrogation. That's been hugely helpful to get your views and insight, and we thank you hugely for that. Message out to the Cullen Wealth clients. Hopefully that's helped. We do have access to people like John if we ever need him. If you have other questions or other things you're keen to understand, please let us know. we'd be more than happy to submit those into our fund manager friends who have got this level of knowledge and insight. So please do bring those to us. But for the purpose of today's session, I'm going to conclude and close that down there. So thank you very much again, John, and we will see you again soon. Thank you very much.